Mercedes took the team.
Ladies and gentlemen, welcome back. Chart Talk number 80, part 2, because Bennett is an asshole and doesn't know how to charge a phone. I don't know. It seems pretty simple. You plug it in and it charges 100%. We're going to fake the energy and give it a go. Let's jump right into the market outlook. So right now we're dealing with a very choppy environment since the market, the market really began under pressure mid-February, February 16th. It's all related to, the 10-year. We haven't heard about the 10-year in years. And now it's tripled since last August or whatever it is. And what it is, it's a reflationary environment, which means a ton of economic growth mixed with a ton of inflation growth, which makes the higher valued risky names. There's less of an appetite for risk in those names. That's why we're seeing all the choppy action in the Nasdaq. And we're on a third day up, and you look at the intraday action. Let's look at the Nasdaq, where we opened. So we opened here. It looks just like we're higher on a chart. We opened higher, came through, took out lows, made new highs, took out lows, made new highs, came in, held the lows, pushed up a little bit. But, you could see the choppiness we're starting to deal with. I'm expecting that kind of action to maintain in the near term over the next few weeks. Definitely have my foot off the gas, taking less trades, want to take higher quality trades, don't have nearly as much risk on as usual, things like that. What are you thinking over there, Ben?
So the one thing, again, broadly in this SPY, we're nearing that 400 level, which is a big psychological level. We saw this last year around the 300 level, and we saw this years back at 200. So at these big psychological levels, people just don't want to buy SPY 400 right now. But in time when we break through 400, you get those very quick and easy not quick and easy, but you get faster moves from 400 to 500 than the consolidation that we're seeing right now. When we look a little bit under the hood, if you pull up that consumer staples chart, the VDC, if we look, a little bit deeper than just the S&P, we look at it, all the major sectors, we can see the staples are starting to break out through all-time highs. We can see the path resistance is going to more likely be higher in this sector. Some of the popular names in the staples are, Procter & Gamble, Coke, Walmart, Pepsi, Philip Morris, Colgate. Things you're going to buy no matter what, no matter if the market's at all-time highs or all-time lows. And if as it breaks this new high, we have a very easy pivot low versus 172. You're risking about 2% to buy that all-time high breakout. And then the next best sector that is going to take a little bit more time to set up is the consumer discretionaries. That's that next chart over. The Amazons, the Teslas, the Home Depots, the Nikes, the things that you're going to buy. But again, when the market's a little rough, you might not buy the extra pair of Nikes as you would right now. And we're seeing the same chart pattern set up as we saw earlier this year. Earlier this year, we saw the consumer discretionaries running to a new all-time high at 250. It put in a new all-time high. It pulled back. It retraced. This is why we typically look to sell the retest, because that's where the people who chased the first time are looking to get out. And that third or fourth time through that resistance level is when we look to buy. And as we saw kind of late 2020 into 2021, once it took out that high, it had a very quick and easy 20% rise to the new highs, which was at this $300 psychological level, which we mentioned also in the SPY. So we're seeing this same thing. New high at 300, pulls in, it retests it. Again, it's all those people who chased the first time at 300 looking to get out and sell, creating resistance. And eventually that group of people leave, and people like Shaker, myself, or the members will buy through that breakout and hold it for that next move to 340, 360, and so on. So again, market's going to be a little choppy. We're probably not going to see much follow through 400 in the SPY, but there is two sectors, staples and discretionary, that have some decent setups in them if you look under the hood.
Absolutely.
So with that, Shake, we'll jump into some of the top ideas. First one was Tyler Kenny looking at HZNP through
this 92 area.
Mm-hmm.
It looks good through the 92 area. We're seeing more and more that you need confirmation for trades. Feelers and things like that in this choppy environment aren't as appetizing. Or what I've done is actually I've toned down my feelers so that I'm literally taking like a one share feeler just to keep my eye on the stock. So you don't want to be in these things early. Above this 92 area definitely looks good, but as we can see today, it found some weakness. So need some more time through 92. Looking good.
All right, next up we got Piton.
So Piton, so this one came in about 30-40% off highs. It started basing out, finding some support on this 200-day simple moving average. We look back at its history. It hasn't traded below the 200-day moving average since it was public for 200 days. So, you look at that area of support, you're finding some buying there. And this is more of a macro swing trade. You buy this area, you have to give it to these pivot lows. And it looks like it's working out pretty well. We got these European lockdowns, things like that. So these lockdown stocks get a little more love today.
Nice. All right, next up we have this Etsy, ETSY.
Etsy. All right, so this is like a perfect description of the environment we're in. So it's Etsy coming into the day, has this little support area, very tight inside day yesterday. And then we look at the intraday chart, and you look at how this thing triggers. If it goes from 220 to 231 or whatever it is, first 10 minutes of the day, really strong volume, looks great, and then just kind of poops the rest of the day, no volume, no follow through. What that tells us is this is all day trader volume. This is all people, who are just looking at the charts. It's not real funds or real whales who are going to push the stock higher past the level. It's all day traders who are looking at the same charts and saying, oh, it had a tight inside day. Let me see if I can sneak into this one. But we're not getting follow through. And that's what we're seeing, pretty market wide with breakouts right now, especially in these high beta, more risky names. So Etsy's just a great example of the environment we're in right now and how it's changing in the near term.
All right, next up we have this Google, Googl.
All right, Google. I'm in this Google. I'm in very light. Anything I'm taking, I'm very light. So there's nothing more bullish when a stock gaps up on earnings and then holds that gap. You might look at it as overbought. You head to a weekly chart, and really it's just a massive flagpole. That's what these earnings gaps are. So that's why we're looking at this Google against the support level. I bought 2040 against 2000. It's at 2057. It's ticking higher. These guys are leading the NASDAQ higher right now. So it looks pretty good. But again, I don't have huge expectations for the market right now. I'm just expecting a chop fest. So staying very light.
All right, a name that's not really on our radar, but on a lot of new traders' minds is this Tesla. TSLA.
All right, so we look at all the charts. All right, look at Google, for example, and how we looked at Google. The reason we liked it, obviously it's a great name, market leader, has the gap up, and it holds this gap, and it's very tight near the support area where it's holding. So we have a tight risk entry that has great upside. You look at Tesla. Tesla's just slap in the middle of this massive support and resistance range. It could go higher, it could go lower. It's going to be completely random. So here's the thing about why I have no interest in Tesla personally and why many new traders do. Many new traders, they want to be involved in the sexiest stocks or the ones that are most talked about. That's why we saw GameStop go crazy, and that's why every question related to GameStop, every question that week was related to GameStop. Haven't heard much about that since. But Tesla, it's just a similar thing. Doesn't have any great tight risk setups where I can go in with really tight risk entry and have huge upside. What I'm just hoping for is that this stock goes vertical again, which is not a good trade setup. So I have no interest in anything Tesla. Mm-hmm. There's a ton of great other names out there that are setting up. So it's just stuck in the middle of a huge support and resistance range. $200 support and resistance range.
Yeah, even just percentage wise, it's like for your Google trade, if you bought the all-time high versus the pivot, it's 5% risk. If you bought Tesla in this range through 700 versus 520, you're risking almost 30% in a nothing setup. So it's like a textbook bull flag through all-time highs, blue sky breakout, 5% risk, or hype name, middle of the range, choppy, no setup, risk 30%. And it's like, choice is kind of yours in that one. Another name, again, we've been talking about that's not very popular has been these home builders, is PHM through 50.
Right, and this is a perfect example. You look at Tesla chart where it's just wide and sloppy and loose. There's nothing going on. You couldn't really pick a direction over the next week. Where this one, it's in a clearly defined macro bull flag, really nice channel. It's getting tighter and tighter at the resistance level. We love this daily consolidation as it takes on this macro weekly level. So obviously this isn't a trade that we're expecting to make 20% a day on, but this is somewhere that seems to me a much wiser place to park your money than something like Tesla. You got to risk a random 30% in.
Mm-hmm. And same with this, 50 versus 48, 4%, prior pivot 46, 8%, 50 versus 40, still not even the same risk as Tesla middle of the range. Next we have this.
Weekly chart is fire.
And then lastly we got this TDOC.
So I'm still waiting on this one. I love the name. I love the telehealth space, but you see how hard this came in after earnings. So this needs a lot of time to work off that selling. In prior environments, we would be able to just quickly, aggressively buy off support and expect this to pop right off support. But again, we're talking about the environment has been changing. So to get me involved in teledoc, I would have to see 4 to 6 weeks of basing and then it be coming out of that base to really be interested versus, I see it's trading around the support level. Maybe I could buy some cheap shares, and maybe it's a tight risk entry, but we're not seeing those names work out as well. So I still need to see more out of this one before I get involved, but on the radar.
All right, I got two more really quick. First one is this MMC through 120. Again, blue sky breakout. It's held that resistance level of 120 going back to pretty much the start of the pandemic. Continues to get up there, just hasn't broken through. And as it continues to test that level, the pullbacks get shallower and shallower, meaning buyers are kind of stepping up and supporting it. So now I can look and buy through 120 in this MMC whenever it wants to go, versus 116, it's 3% risk in a blue sky breakout that can easily, again, it's no resistance once it takes
they
out.
can just trend higher for months.
Yeah. And then this other one is UPS through 163, 165 area. Again, I've been trying to keep an eye on the support to see if it does get tested, this 155. It's just been flagging here, since last August in this just tight range. So we're looking to buy up through 164, 165 versus that 155. Or if it comes in and shakes that 155, look for like a support buyback versus whichever low gets formed. So those are two that we didn't mention that are on my radar. And we can jump into some of the questions if you like.
Let's jump in.
All right, so the first one we had is we can go on our trading background. So Shake, if you want to walk us through kind of how you got started with the markets.
Yeah, so obviously me and Ben met at the trading firm back in the day, 2013. I studied economics and finance in college. It wasn't a super interest of mine. I was more interested in playing football at the time. But my dad kind of led me in. He's like, you figure out the finance world, you at least figure out a job where you get money. And from there, when I was heading towards, senior year, I saw all my older friends taking these jobs, investment banking, in some sort of investment capacity, which is what I thought I wanted to do. And then I saw the scope of their jobs. They're sitting on Microsoft Excel all day. You kind of have to be a bitch to the system a few years to really get anywhere. So, I saw those things. They're really unappetizing to me. And I sat in on a trading floor one day and, just had the liveliness of it, the fact that it was you versus you. I could treat it like a sport. So that's what really got me involved or got me excited about trading. It was right out of college. I didn't really have any experience before that. And so from there, then I joined the trading firm, took a risk on myself. The first year and a half, I didn't, I obviously learned a lot, made a lot of traction, but I didn't make a lot of money. I didn't start making money until really 2 full years in. And then years 3, 4, and 5 is when my account really exploded. I was able to leave the firm, live my own very comfortably, all these things. So, it took me a couple of years to really get the hang of it. I think new traders kind of want to come in and just start putting up big numbers right away, but there's so much to learn. You got to shoot a lot of jumpers before you have a decent jump shot. So, my trading journey is, it was definitely a more difficult road. I have a very small time frame. I try to make really big returns. I'm very tight risk. So, but I know that going in, and through the years, I just get better and better. Had my best year last year. Had my best year the year before that. Would like to build on that this year. So it's all about building. People want to tell me like, oh, it must be so nice you made it and things like that. I made it in some sense, but we're still battling every single day. That's really what my journey's been like. What about you, Ben? What do you got for us?
So again, I started trading, I think I was like 15. This was high school. I was still riding a bike to school. I won like a trading simulation in one of my history classes and just like destroyed my peers in that simulation. So I just figured the market was just very easy. It's one of the main reasons we don't teach demo trading at all, because it's more of a waste of time than anything. But from there, I took some of my profits from a candy business I had at the time to fund my first account. But I started right before the beginning of the financial crisis. This was early 2007, before all that craziness happened. So I watched my portfolio drop 80% at its lows, and all the worst names. I was in financials, I was in automotive, I was in clean energy, which all were the big hype names during that era. So traded through that. I think my second or third year I made like $2,000 profit. When you're 16, 17, you think that's a lot of money. Back when commissions were $18 to buy and $18 to sell. Through that I started to trade in college, gained a little bit more traction. I started to trade more of the leverage ETFs and things that we completely avoid. Had the first comma day, the first $10,000 week, things like that. But then you had the big losses that come with those when you don't understand the rebalancing of those products. After graduating college, 2.4 GPA, barely skirting by. Started to trade at the prop firm with you. We traded there for a couple of years, got the Series 56. And then after a few years trading, the prop firm went to become a financial advisor at one of the largest investment banks, getting my 763, SIE, all the other little numbers that you need to be a financial advisor and manage clients' monies. Where at the prop firm, we were trading our firm's money. Again, all those licenses didn't really mean much. They didn't teach you how to trade. They were just kind of requirements you needed, just like you need your business, college degree to graduate to get your first job. But again, took all those experiences and learned from them, and that's how we met and the business grew. But I was kind of the prime candidate for someone who would have been much more beneficial learning from someone else than trying to teach myself. I tried to teach myself how to trade penny stocks, how to trade options, how to trade these leverage ETFs, and just wasted so much more time doing that myself and way more costly than had I just listened to like our first mentor at the firm who taught us how to properly trade. So again, that was my experience, and that's all I got for you.
All right, love it.
All right, so the other question we had was, what is our Alpha Alerts service? So the trading alert service benefits a person who doesn't want to do the research. The person who doesn't want to scan the charts every day, the person who doesn't want to, form all the game plans and do the hours of research that you and I do every single day. That it's for that person. Every weekend they're going to get, every Saturday or Sunday they're going to get an email from myself from the big picture, which is going to go over the bigger markets and the sectors, where money is rotating broadly, and they're also going to get the Shakedown newsletter that Shake puts together of all the top swing trading ideas for the week ahead. From there, so going from that, the weekend to the start of the week, as those ideas start to approach those breakout levels, for example, if we're looking at a bull flag in Google, and that was one of the setups in the newsletter, that alert you'll get notified of that alert through our app. So as Google's approaching 2040, that alert is going to notify you when it's at 2035. It's going to notify you that the stock is approaching that breakout level. From there, if you like the setup, you can enter the order yourself and trade it as you see fit. When the markets are very busy and very active, there can be dozens of alerts in a given day. When the market's very slow, as it's been the last couple of weeks, it might be one or two or none. Again, we're not trading every single day. We're not forcing trades. We're just finding the best opportunities to invest our money. Along with the Alpha Alert service, there is a dedicated group chat to that. You have full access to our website as well as our mobile app on the App Store. So there's plenty of benefits to be in the Alpha Alert service. The main thing is if you don't want to do those hours and hours of research a week, and you just want to have kind of those 10 or 20 top ideas, that's really that's who it's best suited for.
Right. And the best part, when things are working well, you tell all your friends you're a market savant. When things aren't working, you say Shake and Ben are assholes. Trade. So, there's no liability to you. It's great.
Yeah. All right. So with that, we can jump into some of the good trades. First one, we have Harry Stringer. He had this trade in CMCSA that we can go over.
Comcast, huh?
Yeah.
His name's been going nuts. It's crazy. Yeah. Viacom, all these guys.
Yeah, and if we pull up Vox, the telecommunications sector, it's one of the ones that's leading. Where again, 2-3 years ago, that was one of the hated. This was like before energy was in the doghouse. Telecom was in the doghouse for basically all of 2017 to 2020. Telecom was in the doghouse. Now it's breaking into all-time highs. Looks great. And now we're seeing energy was in the doghouse the last year, and it's slowly kind of coming back. So just broad rotation.
Slowly. That shit was up 40% in 2 months.
No, I mean, yeah, but I'm saying just over.
No, yeah, I know, I'm kidding.
It's still 50% off. I'm talking just broadly off the high. But again, this Comcast trade for Harry, again, very textbook. We talked about this earlier with the discretionaries, that fourth time through resistance. You tend to get a much easier breakout with much less risk. He bought through that 52. He put a stop below that 50 area, had a little breakout, came back, and it turned back up through it finally. He upped his stop, and you can see with those little red lines, as the stock keeps putting in these new pivots, he keeps raising his stop, and then he eventually gets pushed out on the way down. So this is very simply, we look to buy on the way up, we look to sell on the way down, which for most can be a little confusing when you hear it, but when you can see it here, and he bought on the way up, he raised his stop, and as the stock rolled over, he pushed himself out. He took the $4 gain on 50 cents risk. It's 8-to-1 risk reward. I think that was a phenomenal trade.
Sick.
Yeah.
The important part about this trade, so he buys whatever price this is here. He has his original stop. And what I've seen so much lately, because we're coming off an easy market, now we're going into a more choppy market, is the fundamentals of people's trading is often kind of skewed. Because when it's easy, everything's working. You don't need the fundamentals as much. What he did so great here, held the stop. The stock goes up a few bucks, comes back, pulls in, so he's out of the money. But he does not change his game plan until this pivots higher and solidifies this pivot. That's when he moves his stop up, after it pushes up from that area. So he kept his stop in this location, wherever it was, until the stock formed a pivot, an actionable pivot there, where if it broke that area, that would make sense. So he didn't just blindly get out break even because it came back to his price or anything. He kept his trade alive, and then he let the stock do the heavy lifting for him. Great trade. Very, very, very nice trade.
Yeah. All right, so sure, you want to go over a couple of your trades, and then once you're done, I'll go over the two that I have.
Yay. All right, AbbVie, I got fucking lit up. I got smoked in this AbbVie, and it was terrible trading on my end. So here it is. This was trade of the week. We bought this March 12th. I bought a feeler. I didn't add till March, whatever this is, March 15th. It was Monday. Triggered so beautifully. The market was very choppy these 2 days. Name had relative strength like crazy. So the price was 109. I had my stop 107. And then, we got some bad news on our side, and I'll tell you where I messed up here. Now, the news, this is the second time in my career in my 8-year career where I've taken thousands of trades, where the name I'm most heavy in has bad news against it. The news was the FDA doubled back on, one of their drugs. It wasn't a scheduled event. It was kind of a random event. So I don't really have any regrets about the trade. I do have regrets about my out. So I was massively sized in it. Again, my price was 109. I was only giving it to 107. It opens the day at 103.50. So that's a lot more risk than I planned on taking on. We have the 15-minute rule where you want to see it put in that pivot, shake out, and from there, that's your new stop. What happened was I puked my stock into these lows. I just had too much of a position, put a hard stop below 103 after it made this low, and I got pushed out of trade. And it doesn't look great, but it's recovering. It's still, within this macro channel. I should still be in the trade with a stop below this area, definitely. So that was my main mistake, was puking out into these lows. Very, very painful, but again, a very rare occurrence where you just get news like that against you. So the good trade was this Yum. You spoke on it earlier about the consumer staples, the McDonald's, the Nikes. Yum Brands is all your favorite restaurants, KFC and all those guys. So I don't know if they're your favorite. But so I had a feeler this day, this 105 area. I added through the trigger 106. I got some off, obviously not as much as I would have liked to with the pull-in into this 3-day move. And now it's giving me a nice little pivot here, this 107.50 area. So I have a stop for some of my stock in that area. I have a stop for some still below this 105 area. So, the good part about this trade, making adjustments. I wasn't forcing it in the tech land or anything that wasn't working, just, exhibiting my will on the stock. I went to where the money was rotating. This is a really nice pattern coming out of a nice consolidation. And this one still looks really good, putting a pivot here at this, previous resistance area, finding some new support. So this one definitely looks good from a macro perspective. So this is definitely a good trade. What you got going on?
All right, so first one's this Dash. I'm going to pull up the chart.
You got it.
All right, so this is typically something away from our typical wheelhouse of buying through the all-time high. This was one where this Dash was coming near these 52-week lows, and most would expect it to really flush this 130 very hard. Every person who's long the stock is basically out of the money. They're losing money because it's lower than it's ever traded since it's gone public. So you would expect most sellers or most investors to want to puke out. As it pushed down through those lows, there was just no selling volume. It went down a couple cents and came right back. So seeing that, this is like one of those rare occasions where you can take a chance on a low risk trade, but you can potentially get a very good entry price. So here, I bought up through the high of the day versus the low. So I bought up through 136 versus that 127 low. It started to kind of flag out here again. Not really flag, I'm sorry, but just a lot of indecision, just a lot of inside days. No one's really picking a side. The sellers aren't, pounding the bid, and buyers aren't really taking the offer yet. It's just kind of hanging out. But for now, I'm still in it versus that 127 low. And if it turns up through 140, I have a buy stop to trigger me in and continue to buy on the way up versus that 127. And we've seen in the past, through this 150, 160 area, this name can wake up and really get some volume behind it. So if I can sneak in here light versus that low, I can be better prepared to add if and when this name wants to wake back up in the future. But again, this is a trade, 1 out of 100, I'll take this, but this is not really my bread and butter. The next one is this DHR. All right, so again, we can see this big range DHR has been in. You can see support has been this 211, 212 area, and resistance has been 248. So as we see it coming into this 212, again, most would expect, as I was expecting it to, bear flag and break down through 212. But as it came down there, the sellers just weren't there to, push it down lower. And in reverse, it just, turned back up. So we bought back up through the high of that little range. So I bought up through 220 versus 212. That's my hard out. And for now, if it wants to, continue to grind up versus that 228, that'll be kind of the next spot that I'm looking to add to it. Again, I'm buying on the way up. I'm dollar cost averaging on the way up versus that pivot. And we can see this range. So if it gets back up to 248, that'll be kind of the first area to look to take profits. but still in this big range, the third time back up to that major level, more than likely will head higher. So if it can consolidate and flag, we'll look to add through that. But this is kind of just the beginning of this trade. Again, not going to be a quick day trade. It's not going to be a 2-3 day trade, but it can be one that we can build into to be prepared for that bigger breakout down the road. So those are the 2 trades I put on last week that I'm still in. So with that, Jake, if you want, we can jump into Book of the Week.
Ooh, would love to. So I'm still reading Texas Hunt Dynasty. It's so funny. It's like reads like a soap opera. This guy was absolute legend. This is only in the 1920s, 30s, so it was more Wild West during the oil boom in the U.S. Everyone was moving out to Texas. He left Kentucky to move to Texas, and he was just making money playing poker. He eventually used poker money to open a little casino, like an underground casino, and then from there, he was able to invest in oil rigs and things like that, which eventually led to him being the wealthiest private citizen in the world, all from, these like $2 poker games that eventually led to all these things. And for me, I'm a very short-term trader. The relevant aspect for this to me is I try to use my short-term trading gains to, invest in more, big picture and long-term things because I know my trading income is so risky and things like that. So that was definitely parallels I saw from this in my life in this, but it's been very interesting. I haven't gotten into any of the juice yet. But overall, seems like it's going to get into some good stuff soon. The guy had a very interesting life. Very good entrepreneurial lessons in this one. What you reading over there?
All right, so I got another Jesse Livermore book, How to Trade in Stocks. Again, staple, very easy read. A lot of the principles that we trade off of, going off the same principles that Jesse Livermore trade off. Again, we buy through highs. We follow, we trade the leaders. We see how, where the relative strength is. We don't buy what's cheap. We keep things simple. A lot of the simple principles that we follow are all from, lessons that basically Jesse instills. But yeah, very good book. Highly recommend.
Cool. All right. Looks like we made it through.
We did, and it's still recording.
All right, guys. You can like, subscribe, give us a comment, ask some questions. Let us know what you want to hear. We're doing this for you guys. So your input is very helpful, whatever it may be. You want to call Ben an asshole because he doesn't know how to charge a camera? Call him an asshole. I don't know. He's an asshole. But other than that, we'll see you guys next week. 2 weeks. I'm going to Mexico. Fuck y'all. Later.